Let's dive into the world of the housing market, but we can't talk about the housing market without bringing up interest rates. For over 6 months now, we've been floating around the 6 or 7 percentile, and that's the Fed's way of telling us if we keep getting activity in a housing market, we're just going to keep raising interest rates. Don't believe me? Check out this chart. As you can see, at the start of 2022, we had a huge increase in the number of contracts. Then they started to increase rates, which started this downward trend till it started to fall straight down when rates approached the high fives by July. Then demand jumped up again when rates were in the low fives. Once rates started rising as high as 7% in October, where we saw contract numbers trend down again, and by the end of the year where they typically go down because housing market is seasonal. Then in the first quarter of 2023 with lower rates, at one point we were at 5.8%, and then again we saw contracts trend up. But as rates started going up, contracts started trending down. Then when rates cooled down and we saw some growth, we got hit with a 7% interest rate, so we already know what's going to happen to buyers. And if you don't see the pattern yet, it means expect less buyers buying houses as long as rates continue to stay this high. But it also tells us that we have plenty of buyers willing to buy houses just as soon as rates come down. Just remember, when you're waiting for rates to come down to buy, that you're waiting to compete with other buyers waiting for the same thing. But the question on everyone's mind is, what will rates be in 2024? But since I can't predict the future, I won't be making any guesses.
Yes, I am seeing you in your home.
I just hope we're not in the sevens, but I'm curious what your guess is. Let me know in the comments down below. Now, since I get a lot of people asking me this question, I figured I'd go over it as well, and that is the recession. This is your 30-year mortgage. This is your 10-year treasury. This is your 2-year treasury. And this is your Fed rate. So when they talk about an inversion, they're talking about when the short-term treasury goes higher than the long-term treasury. So here's an inversion here, and again here, and right now we are in a major inversion. And as you can see, it's moving up and down. And because we don't really know which way it's headed, the Feds don't know what their next move is, which is why they aren't telling us whether or not rates are going to go up or down. It depends on where the short-term treasury ends up. And if we do get another inversion, that'll put us in a recession. And what happens to rates during a recession? That's right, they go down. Just remember, not every recession leads to a housing market crash, especially when so many people have a large amount of equity in their home, and a majority of them with record low rates, below what most people are paying for rent right now. So just keep that in mind. I get a lot of questions from different people asking where the market's headed. And to answer those questions, I've made this video to help guide some people that may be looking in the wrong direction. These are not leading indicators. Here are some leading indicators. Weekly updates on anything having to do with closed sales, like in these examples here. Another example of what not to go off of is the census income data, which is a year old already, or the inflation rates, which is also almost a year old. Here is some data that'll help you see where the market is going. Here's a list of all the cities' market index, and all but 2 cities are in a seller's market. Maricopa City and Queen Creek are in a balanced market for now. And in this chart, you can see that the market isn't really moving much. All you should get from this is your home value is stable, meaning you get to buy your home for the long term, and you're not going to see your home decrease or significantly increase. This does affect short-term investors like home flippers. Now, as long as we stay in a seller's market, you can still flip homes. Just be careful. If you ever see the market start to do this, then that's an indicator to sell all your properties and wait if you're a flipper. When it comes to our supply and demand, people are surprised to see prices still going up when demand has started to go down, like in this chart here. As an industry, this number right here represents a normal level of supply and demand. If you go back to 2015, 16, 17, 18, and 19, you'll see that it was mostly around normal levels of demand. So while we had this nice 5 to 8% annual appreciation rate, our supply was dropping. We were at a very similar market as we are now. See that gap? We were doing very well in terms of volume because this is where our demand was. Here we are. We are still seeing prices increase because of this, but we are both below normal. What would happen if rates went down? I think you'd see both your demand and supply increase together, keeping us in a seller's market. I'll be doing a video soon comparing renting for the next few years to buying, so make sure you look out for that. But for now, let's look at this chart comparing the end of last year to today. So in this chart, we're comparing the end of last year to August. So we have the median sales price up by 20K, over asking price up by 11%, seller concessions down by 11%, median concessions down by 1,400, and obviously that would make below asking price go down as well, so your negotiation power for buyers has gone down a little bit. Average days on market has gone down significantly. It's gone from 55 days down to 20 days. I hope you learned something today, and if you have any questions, feel free to ask. And if you need any help buying or selling, you can contact me for more information on that. Thanks for watching, and we'll see you on the next one. That's a wrap.